Hey everyone, welcome to our channel today. We're diving into a topic that has serious implications for the global economy. China. For years, China has been hailed as an economic powerhouse, experiencing unprecedented growth and establishing itself as a major player on the world stage. But recently, cracks have begun to appear in this seemingly impenetrable facade. From plummeting stock markets to a deepening property crisis, the warning signs are flashing red. In this video, we're taking a hard look at 10 alarming signs that suggest China's economy might be on the brink of collapse. Imagine walking into a luxury condo building and seeing units listed for 60% off their original price. Sounds too good to be true, right? Well, that's the reality in some parts of China right now. One of China's largest property developers, Country Garden, recently resorted to slashing prices by up to 60% in a desperate attempt to attract buyers. Now you might be thinking, so what? Cheap condos for everyone. But this fire sale isn't a cause for celebration. It's a glaring symptom of a much deeper problem plaguing the Chinese economy, a looming property bubble. For years, China's economy has been heavily reliant on its real estate sector. Construction and property sales have fueled economic growth, but this rapid expansion has led to inflated prices and a mountain of debt. Now that bubble is showing signs of bursting. When a major developer like Country Garden is forced to offer such drastic discounts, it's a clear indication that demand is drying up. This isn't just a Chinese problem, it has the potential to send shockwaves through the global financial system. The stock market, specifically the Chinese stock market. Since 2018, Chinese stocks have taken a nosedive, losing over 27% of their value. That's a significant drop, and it's not just a blip on the radar. This decline reflects a growing lack of confidence in the Chinese economy. Investors are getting spooked by a multitude of factors, including the ongoing trade war with the United States, the struggling property market, and the government's increasing control over private businesses. When investors lose faith, they pull their money out, and that's exactly what we're seeing in China. The Shanghai Composite Index, one of the country's main stock benchmarks, has been on a downward trajectory, wiping out trillions of dollars in value. This stock market slump has serious implications for the Chinese economy as a whole. The question now is, can the Chinese government find a way to restore investor confidence and prevent a full-blown stock market crash? The answer remains to be seen. When it comes to gauging the health of an economy, sometimes it's helpful to follow the money. And in China, the money seems to be heading for the exits. A recent survey revealed that a staggering 50% of Chinese millionaires are considering moving their wealth out of the country. That's right, half of China's millionaires are looking for greener pastures, and it's not hard to see why. They're worried about the very same issues we've been discussing: the slowing economy, the property bubble, the trade war, and the increasingly uncertain political climate. This exodus of wealth is a major blow to the Chinese economy. When wealthy individuals and businesses move their money out, it deprives the country of valuable capital that could be used for investment and job creation. If those with the most to lose are looking for the exits, it raises serious questions about the long-term viability of the Chinese economy. This trend of capital flight is something to keep a close eye on. Fire sale. It's not just average millionaires who are getting out of China. Even the ultra-wealthy, those who own some of the world's most expensive real estate, are starting to offload their assets. We're talking about properties in prime locations like Hong Kong, London, and New York City, the kind of trophy assets that were once considered untouchable. But now, even these seemingly safe havens are being swept up in the global wave of uncertainty. High net worth individuals, many of whom made their fortunes in China, are selling off these properties at a rapid pace. They're cashing out, diversifying their holdings, and moving their wealth to safer jurisdictions. This fire sale of prime real estate is a clear indication that the super rich are bracing for a potential economic downturn. This trend has the potential to create a ripple effect throughout the global real estate market. China's biggest developers are going bankrupt. Remember Evergrande? It was one of the biggest real estate developers in the world, and it went belly up in 2021. This wasn't just some isolated incident. It was a major red flag for the entire Chinese economy. Evergrande's collapse was due to excessive debt, a slowing economy, and a property bubble. The company had over $300 billion in debt, and when it couldn't make its payments, the whole house of cards came crashing down. This wasn't just bad news for Evergrande's investors. It sent shockwaves through the entire Chinese financial system. Banks, suppliers, and contractors who had done business with Evergrande were left holding the bag, facing billions of dollars in losses. Several other major Chinese developers, including Fantasia Holdings and Cynic Holdings, have also defaulted on their debts in recent months, highlighting the systemic risks within the Chinese property market. These bankruptcies have the potential to trigger a domino effect, leading to a credit crunch and a wider economic crisis. Bad loans explode China's ticking time bomb. Bad loans are unlikely to be repaid. In China, bad loans are a ticking time bomb. Debt is starting to go bad. Businesses are falling behind on loan payments. Developers struggle with unsold inventory and debts. Experts believe bad loans are worse than reported. This threatens the Chinese banking system. A crisis in China could impact the world. Let's talk about debt, specifically household debt. For years, Chinese consumers have been encouraged to take on more debt to fuel economic growth, and they've responded with gusto. Household debt in China has skyrocketed in recent years, reaching worrisome levels. This surge in borrowing has helped to prop up the Chinese economy in the short term, but it has also created a ticking time bomb. When consumers are saddled with high levels of debt, it limits their ability to spend and save. Moreover, if interest rates were to rise or the economy were to experience a downturn, it could lead to a wave of defaults as consumers struggle to keep up with their loan payments. This situation is eerily similar to what happened in the United States in the lead-up to the 2008 financial crisis. The trade war between the U.S. and China? Well, it's not over. It's still simmering in the background, and it has the potential to erupt at any moment, further destabilizing the Chinese economy. The trade war, which began in 2018, has already taken a toll on both countries. Tariffs have disrupted supply chains, increased costs for businesses and consumers, and dampened economic growth. While both sides have reached a truce, tensions remain high. The underlying issues that sparked the trade war, such as China's trade practices, intellectual property theft, and forced technology transfer, have not been fully resolved. If the trade war were to escalate, it could have dire consequences for the Chinese economy. Increased tariffs would further damage Chinese exports, while restrictions on technology transfer could stifle innovation and growth. One of the most concerning signs of a potential economic collapse is rising unemployment. When people are out of work, it not only impacts their livelihoods but also has a ripple effect throughout the entire economy. And in China, unemployment is a growing concern. Official figures show that unemployment is on the rise, particularly among young people. The situation is even worse than the official numbers suggest, as they don't fully capture the true extent of underemployment and hidden unemployment in rural areas. This growing unemployment crisis is a direct result of the slowing economy. As businesses face declining profits and economic uncertainty, they're forced to lay off workers or reduce hiring. Rising unemployment has the potential to create social unrest and instability. A surge in unemployment could threaten the government's grip on power and lead to widespread social unrest. For years, China has been the engine of global economic growth. But that engine is sputtering. The Chinese economy is slowing down, and it's happening faster than many experts predicted. Official figures show that China's GDP growth has been declining in recent quarters, and many economists believe the true extent of the slowdown is even worse than what's being reported. This slowdown is a result of a confluence of factors, including the ongoing trade war, the bursting of the property bubble, and weak consumer demand. As the world's second-largest economy, China's slowdown has significant implications for the global economy. A sharp decline in Chinese demand could trigger a global recession, as businesses around the world feel the impact of reduced exports and investment. Moreover, China's slowdown could lead to a currency war, as countries compete to devalue their currencies in an attempt to make their exports more competitive. The Chinese government is facing mounting pressure to address these challenges and prevent a full-blown economic crisis. So, there you have it. 10 alarming signs that China's economy might be headed for a crash. From a collapsing property market to soaring debt levels and rising unemployment, the warning signs are flashing red. The Chinese government has proven adept at navigating economic challenges in the past, and they have a number of tools at their disposal to try to stabilize the situation. However, the challenges facing China are significant, and the potential consequences of a full-blown economic crisis are far-reaching.